Hello, and welcome to Deflationary Investment. This analysis is for macroeconomics as of 9th of July, 2026. The full report is on deflationary.ca. A hawkish Fed and reaccelerating inflation meet cooling growth and a live oil shock. Stagflation now leads at 38%. Respect the higher for longer tape now, hold the inflation hedges for later. Four scenarios are always in play, and this run the balance tilted. Stagflation, growth slowing while inflation stays sticky, leads at 38% as a hawkish Federal Reserve under its new chair meets reaccelerating prices. A reacceleration is 26%. A soft landing has slipped to 22%. And a deflationary bust is the 14% tail. Crucially, the tape confirms the hawkish read rather than fighting it. The 2-year yield sits above the funds rate, the 10-year has risen to 4.56%, and the dollar is firm. Unlike the prior read, narrative and market now agree. The money is moving the way a higher for longer regime dictates. Financials benefit from a steeper curve. Energy is bid by the oil shock and scarcity. Industrials ride reshoring and defense spending. On the other side, long-dated treasuries and real estate are leaking as the 30-year yield pushes to 5.06% and mortgages sit near 6.49%. The consumer softens as credit tightens. The fresh entrant is the Iran-Hormuz oil premium, which lifts energy and defense while dragging the global trade-exposed corners of the market. Positioning splits by horizon. Near term, respect the tape, favor financials and energy, lean on the firm dollar, and go light on long-duration bonds, real estate and the consumer. Gold is capped short-term by high real rates, though the Hormuz safe haven bid offsets some of that. Longer term, hold the structural book, gold, silver and copper on debasement and electrification, inflation-protected bonds while prices stay sticky, and technology for the productivity trend, sized carefully for its concentration risk. The risks are loud, and they cut both ways. The biggest tail is the one that's armed but not triggering. The S&P 500 is led by a handful of AI megacaps, making up roughly 41% of the index, on partly non-operating earnings, so a reversal there is an index-wide drawdown, not a tidy rotation, and breadth narrowed again this week. The Iran-Hormuz shock is a genuine two-way risk. It lifts energy but drags growth, and a closure of the strait would be a sharp escalation. And private credit remains the cycle's untested fault line as higher for longer squeezes refinancing. So, our call on macroeconomics, stagflation light. Remember, this is for education, not financial advice. Always do your own research. This analysis is by Deflationary Investment at deflationary.ca. The link to the full report is in the notes below. Have a great day.